So Labour have U-turned on their plans to reintroduce the pension lifetime allowance. Makes me very happy, that, for lots of reasons, and not least because I've always said that it would be difficult for them to reintroduce it, and now I've been proven right, hence the smug face. Also, politicians, U-turns, what else is new? But pensions are potentially still under threat, so what else might be in store for your pension, whoever gets in power this time? Hi, and welcome back to the channel. My name is Pete Matthew, and I'm a 26-year veteran chartered financial planner based here in the UK. And this video is brought to you by Meaningful Academy Retirement Planning. More on that a little bit later. So yeah, the lifetime allowance is gone for good, or so it would seem. And this is despite the Institute for Fiscal Studies suggesting that they could bring it back and saying that it might not be a bad idea to do so. So, phew. I always thought that it didn't really make sense to incentivize saving into a pension with tax relief and then disincentivize it at the other end by taxing it really heavily if your pension provision was above a certain figure. Now remember that there is still a kind of ghost of the lifetime allowance around in the form of the lump sum allowance, and that limits the amount of pension commencement lump sum or tax-free cash that you can take from your pension, just like there was when the lifetime allowance was a thing. But if there's not going to be an overall limit to pension provision anymore, I reckon there are three main options for future chancellors of whichever party to come after. And the first is tax relief. So as it stands now, whatever you pay into a pension, you don't pay tax on, effectively. So if you earn £100 and you're a basic rate taxpayer, you would pay 20% income tax on it and you get to keep £80. But if you pay that £100 into a pension, you get to keep all of it. Now you would have had to have paid the tax anyway if you take the 100 quid into your bank account, and you only would have had £80. So by shifting the £100 into your pension, really it's only cost you £80. HMRC have essentially given you your tax back. Now currently you get the same rate of tax relief as whatever you pay in income tax. So if you're a higher rate taxpayer paying 40% income tax, you will get 40% pension tax relief. Now the mechanics of getting tax relief are different depending on whether you pay into a pension via your pay slip if you're an employee, or if you pay into it from money that's in your bank account which has already been taxed. But the end result is the same, really. Now one possible change that a future chancellor might make is to meddle with this tax relief, perhaps by applying a flat rate for everyone. And the figure that's been bandied around for actually quite a long time now is 30%. So if you're a basic rate taxpayer, you would be better off, because now £100 into your pension has only cost you 70 quid, not 80. If you're a higher rate or an additional rate taxpayer though, you are going to be worse off. Now how they would administer this, I think, would be interesting. Essentially, higher rate taxpayers would be taxed in part on money that they paid into a pension. So would the pension companies be responsible for calculating this and paying it on to HMRC, or what? If not, then payroll systems, I think, would need to be changed quite considerably if it was going to be administered through PAYE. Now, working it out through self-assessment system, if you're self-employed or if you need to do a tax return for whatever reason, that'd be simple enough. But thinking about administering a flat rate tax relief started to make my head hurt, so I stopped thinking about it pretty quickly. But I reckon that if they do mess with pension tax relief, legislation on that will be some way off. That'll be quite an unpopular move potentially, and I reckon this is probably the least likely way that pensions are going to be affected in future. And as I said, I think it's also worth mentioning that this possibility has been mentioned before just about every budget for as long as I can remember. So it's not a Labour or a Tory thing, it's not a general election 2024 thing, just a possible way that politicians of any colour could rate our pensions for tax. More likely, I think, is that the annual allowance will be adjusted in some way. Now, as it stands here in 2024, the maximum you can put into a pension to get tax relief is 60,000 quid, or 100% of your relevant UK earnings, whichever is lower. Now, you can also carry forward unused allowance from the 3 previous years, but still, your relevant earnings in the year in which you make the payment, that's the overall limit for how much you can pay in. The annual allowance is tapered for very high earners down to £10,000 a year, and it also steps straight down to £10,000 if you have accessed taxable benefits from a money purchase pension. That's called the money purchase annual allowance. Now, if you contribute more than the annual allowance, you will pay an annual allowance charge. based on whatever your income tax rate is. Now, potentially, a future government could reduce the limit back down to 40,000, that's what it used to be a couple of years ago, or some other figure entirely. They could adjust the rate of annual allowance charge, perhaps making it a bit more punitive to go over. They could bring the threshold down over which the annual allowance is reduced for high earners. All of these options don't actually change the mechanics of how the annual allowance works. It's just the figures and the limits and the thresholds that would change. So that would be fairly easy to implement, I think. Now, before we get into the pension tax option that I think is most likely to be considered, can I ask a favor first of all? If this video is helpful or interesting, please give it a like and subscribe to the channel for loads more videos on how to navigate the UK personal finance system. And secondly, check out Meaningful Academy Retirement Planning. This is an online course with my most distilled learning in one place about how to plan and execute the perfect retirement. We cover investing in retirement, planning and finessing what income to take from where and when, and also how to review things regularly as life goes on. There is a year's included access to the incredible Voyant Go financial planning software, and there's a thriving community of nearly 600 people in a private Facebook group, all of whom are in a similar situation and looking to help each other out. We have live Q&A calls each month where you can ask me anything and get the benefit of my quarter century of experience helping people retire well. So check out meaningfulacademy.com/retirement planning, and if you decide that it's for you, don't forget the coupon code YouTube for a discount. And there's even a 30-day guarantee if you don't think the course is valuable once you've bought it. So check it out, and maybe I'll see you on the inside. I think the most likely option for any future pension tax raid is on death benefits. Now, back in 2015, when pensions were made super flexible, the changes meant that pensions were now more tax efficient as a vehicle for passing wealth to our families than they are for retirement income. Pensions are currently completely outside your estate for inheritance tax purposes, and they have been actually for decades. But if you die before age 75, you can leave your whole defined contribution pension fund, whatever's left of it, to your beneficiaries completely free of tax. And even if you die after age 75, the pot can pass to them tax-free, but if they draw anything down from the pot, they will pay income tax at their highest rate. Now, most people know that you get a tax-free allowance called the nil rate band before your estate pays inheritance tax. Currently, that's £325,000 per person, and it has been for a while. There's an additional residence nil rate band of £175,000 that you get if you pass your main residence to your direct descendants. Add all that together, and if there's two of you, married or in a civil partnership, that's potentially £1 million that you can leave tax-free to your family. But I reckon any future chancellor is going to be eyeing those generous death benefits on pensions as fair game. Since the lifetime allowance was abolished, I believe that there's a potential for something like a pension nil rate band, where the first £500,000 of your pension fund is tax-free on death, say, but above that there's a tax charge. Whether that tax rate is aligned with the inheritance tax rate of 40%, or some different rate, that all remains to be seen, as does whether this happens at all. They could even tweak the rules on death before and after age 75, perhaps removing the much more efficient pre-75 rules altogether. But I think some kind of death tax raid on pensions will be an easy win for the Chancellor, because it'll be brand new legislation, so there's no real precedent. They can sell it as a tax on rich people's pension funds if they set the pension nil rate band high enough so that most ordinary people aren't affected. And it would be easier to administer as part of the inheritance tax probate regime that everybody goes through when they die anyway. So tell me, what do you think? I really don't think this is a Labour thing or a Conservative thing, not really. It's just looking increasingly likely that Labour will get in this time, but we'll see. Pensions have been a political football forever, and if there's a need to raise taxes without affecting those with lower earnings, then pension tax relief, tweaking the annual allowance, and maybe adding death taxes to pensions might just be attractive for a future Chancellor of any colour. But I'm a big believer in planning around what you know to be true, rather than trying to second guess what might be coming down the road. But you know, I'll be keeping a close eye on things, and I'll be making videos about any future changes so that we can navigate them together. So thanks for watching this video. Hope it was helpful. If it was, give it a like and subscribe to the channel if you're not already. And maybe watch this video next about why you shouldn't rush to make financial changes before a big event that you can't control, like, say, a general election. And I'll see you next time.